All right, Chapter 10, Plant Assets, Natural Resources, and Intangibles. Sometimes this is also known as fixed assets. It's a big chapter, so let's get into it here. Plant assets. These are tangible in nature. Tangible means physical, real. It's actively used in the operation. Obviously, you're expecting future benefits for periods to come. And plant assets are also known as property, plant, and equipment. So this could be your building, land, your factory, and all the equipment that goes into it. So these are your long-term assets used in your business. Plant assets is an asset value, and it's going to decline over its useful life. And this will be known as depreciation. And so we have a few things we have to look at. Number one is our acquisition costs, and there's a variety of things that can go in there, from transportation, insurance, as well as, of course, the purchase of the assets and so forth, and any expenses that is incurred to get it up to speed. How long do you plan to use it for? This is going to impact your depreciation schedule. And then, of course, is there any value when disposing it, and so forth. So, cost determination. Again, a variety of components that can determine the cost, starting with the most obvious is the purchase price. It does exclude any financing charges and cash discounts. The financing charges is added to something else. And then all expenditures needed to prepare the assets for intended use. Again, transportation, insurance, could be employees setting it up and so forth. So it can be a variety of things for that total cost. Land is separated from the buildings, and again, a variety of components that go into this. Again, the purchase price, maybe real estate commissions, there's title and maybe transfers fees, surveying fees, can be some delinquent taxes. The thing you need to note is that land is not depreciable. You never depreciate land. It's always held on your books at cost, and cost is all these various aspects that go into the cost of the land that will be held in your books. Land improvements, however, are depreciable. And land improvements can be things like parking lots, fences, driveways, maybe lighting systems, and maybe even landscaping. Now those are depreciable over its useful life, but not the physical land itself when you buy it. Buildings, they are depreciable. Obviously they don't last forever. So again, a variety of fees that go into the cost: title fees, brokerage fees, maybe attorney fees, taxes, maybe cost of purchase or construction. So there's a variety of components that go into the cost also. Machinery and equipment, same concept. It is depreciable over its useful life, and a variety of components that go into its cost. Lump sum purchase, total purchase of land and building. So, usually when you buy a building and land, there's just one price, and so you have to separate out on their basis of relative fair market values. It's an estimate. You might have a variety of third parties give you their estimates that might help validate what you're doing, but you do have to separate that. So as you can see here, we have land improvements, and then the building. We'll separate all that out. And these two are depreciable. This will not be the land. Leasing versus purchasing an asset. Leasing is a common occurrence for a lot of these major assets, and there are some advantages to leasing. One of the advantages is reduced risk of obsolescence, because usually your lease is for a shorter term and you can always upgrade. You'll see this a lot with like automobiles. Automobiles might have a 3-4 year lease. Maybe at the end of 3 years you turn it in and get a newer model. That also applies to equipment and other equipments and so forth. Another advantage is often there's little or no down payment, which helps a lot of people get into these assets like cars and so forth. There are some tax advantages, because if it's an operating lease versus a capital lease, there's two different kind of leases. And leases, let me just state, is a huge area of abuse, and it's a very problematic in the industry. And the FASB and the SEC is still making changes to this area, significant changes, and it's a moving target a little bit. But there are two types of leases. One is known as an operating lease, which is more shorter term, and a capital lease. And a capital lease is you don't get to write off the payments because it really says that it's just another way of purchasing. Whereas operating goes into your operating expenses like lease payments on a car, for instance. But if you do lease it, you don't show it as an asset on your books because you don't own it. If it's a capital lease, then you would. So it gets a little technical here, and leases is a specialty in itself. Depreciation. Okay, we've studied this earlier, so it shouldn't be that challenging here, but you have your acquisition cost, and then you're going to allocate this cost over a period of time, hence the depreciation. And it will be an income statement expense as you for every period that you do depreciate this. And it is a contra account here. It's a contra asset account. So factors in computing depreciation, again, the cost, the salvage value, and then its useful life, whether it's measured in years or maybe units of production. There's a variety of techniques here. There are a variety of depreciation methods, which is confusing for students. And you need to spend a little bit of time here and focusing on this because I will test its various and components here. The straight line is the simplest. It's going to be you just spread it out over a period of time and then you just take it an equal amount every period. Whereas units per production is sort of like how much are you actually using this product. For instance, if it's a car, you might say based on number of miles. If it's a piece of equipment, maybe how many pieces did it make. So that's another method. And the third one is a declining balance. This is special because there can be a straight declining balance or an accelerated declining balance. This is used a lot for tax purposes, and so you do need to be aware of this. We'll get into this in a minute. So let's go into the different methods. Straight line. Again, you take its cost, okay, and you minus out the salvage value. Because the salvage value says there's some residual value that you know you'll always be able to sell it for. It might be just for the metal, as an example. And sometimes there will be no salvage value. That's legitimate sometimes. It is just an estimate. Those estimates can change over time, and you can adjust over time. And management does sometimes, and sometimes it's abused in this area. So anyway, the formula is simply the cost minus the salvage value gives you its depreciable value, and then you just divide it by its useful life in periods, whether that be 5 years, 3 years, 7 years, and then you come up to this, and then you just divide it by 12 to get a monthly amount, and then you simply depreciate. Now here they're just depreciating it just for the whole year, and you notice you have an income statement item called depreciation expense. An accumulated depreciation, which is your contra account, is a balance sheet item. And again, they're recording it as an annual depreciation here. So, what happens on using the straight line, and this will be true of other methods too, is that you have a depreciation expense on your income statement. And then you have the book value on your balance sheet, and the book value is going down. And the reason why is you have your machinery at its cost that you purchased it at, less the accumulated depreciation. And this accumulated depreciation will grow for every period that you keep the machinery, whether that be by the month, the year, the quarter, or units of production, and so forth. And so the net amount, which is also known as book value, this is the value you're showing on your books, is this amount. Understand that book value has maybe no relationship to market value, completely different. This could be, the market for your car might only be $3,000, but you showed it on your books at 6,400. So there can be a difference between book value and market value. Straight line depreciation schedule, so they're just giving maybe a depreciation rate of 20% and it just goes down $1,800. And then it goes down to your salvage value. You won't depreciate the salvage value. Units of production method, same thing. Again, cost minus salvage value will never change to get your depreciation value. Now you're just going to divide by the total units of production, i.e. how much are you actually using this machine. And this will, and that will give you a variety of different depreciation expenses for a variety of periods depending on your usage here. So again, here they're just costing it out. If you're doing 7,000 units, you just divide this by the 7,000 and you get 25 cents a unit and you multiply it out. And again, that can vary from period to period depending on your usage, rate of usage here. And again, this will just show you how it goes down, and your book value, notice it says book value, can also be net value sometimes, goes down to its salvage value. And it'll stay at that salvage value until you get rid of the machinery, whether you sell it or take it to a junkyard and so forth. The double declining balance. Understand that there's a variety of declining balance methods. There's one that's used extensively because the government has set terms, and it's called MACERS for tax purposes. MACERS is an acronym for Modified Accelerated Cost Recovery System. That's one method. You can have a double declining method, and a lot of this is based sometimes for tax purposes. And so what you're doing here is you just take maybe the straight line, and if you're dividing the straight depreciation method, if you're using it over 5 years, you would depreciate it by 20%. Well, the double declining says, well, let's take that rate and multiply it by 2, hence the term double. So now we're going to do 40%, and you'll do this 40% for every period. So again, so what happens here is you multiply your depreciable value by 40%, you get 4,000. Is it going to be 4,000 in the next period? No, because what you're going to do is you're going to subtract that 4,000 to get the net value of 6,000, and then you'll take 40% of that 6,000 in the next period. And so it'll always be based on the net, not on the cost value. So as you can see, they're taking 40,000, 4,000. You subtract that 4,000 from the 10, you get 6. You take 40% of that, it goes down to 2,400. Subtract that from here, and now you get 36, and so it goes down and down. What happens when it gets to become very small, at 1 year you'll just wipe it out. You won't necessarily follow that formula. You'll just adjust your books because it becomes too petty after a while. And again, comparing, you're still going to depreciate the 9,000 in total, but the amounts per year will vary depending on which basis. And the reason why the double declining balance is used for tax purposes, notice you get the biggest tax write-off in your earlier years, which matches sort of helps for that increased write-off. But again, your total write-off will be the same over those 5 years, but you do get an accelerated value. And based on the cost of money, there is a financial advantage to doing so. And this will just give you an analysis of methods used by a variety of companies. Most people just prefer the straight line because it's simple, and they'll do this both for tax purposes and financial purposes. But understand that you can use two different methods, one for your financial reporting and another one for your tax reporting. Gets confusing? Consider it job security. Okay, again, most corporations use the Modified Accelerated Cost Recovery System. The government has done this for a gazillion forms of different equipment, and this sort of sets up the point that you don't have any IRS hassle by using this method, and this is one reason why most corporations tend to go this. And it is an accelerated depreciation schedule, so it does help with the tax purposes, and this is one reason why. I'm going to stop here, and we'll start on another part 2.